Microsoft just burned through capital expenditures of $35.8 billion in a single quarter, yet the market is celebrating instead of panicking. Does this mean the crowd is blinded by artificial intelligence hype, or is there a hidden structural advantage analysts are missing? Azure revenue growth hit 43% year over year, pushing the cloud platform past a $100 billion annual run rate. Headlines scream this validates optimistic projections, proving enterprise clients are eager to deploy these systems. Yet operating at a $100 billion scale means the company is priced for perfection. Any slight deceleration in that revenue growth figure could trigger severe valuation recalibrations among institutional investors. To grasp why stakes are so high, we must look at how clients pay for this infrastructure. Commercial remaining performance obligations surged 84% to reach an astonishing $678 billion. The consensus assumes this reflects immediate demand, ignoring unprecedented long-term revenue visibility. This metric proves corporate clients are locking into substantial multi-year contracts for artificial intelligence workloads. By securing $678 billion in future commitments, the firm builds an incredible psychological safety net. This pipeline confirms the structural shift toward AI-powered enterprise software is fully underway and financially committed. With sticky demand driving these obligations, we must address how the business actually fulfills these contracts. Capital expenditures doubled year over year to $35.8 billion in just one quarter. Consequently, the free cash flow margin contracted sharply to 21.8%, a steep drop from the 33.4% free cash flow margin seen in the prior year. Casual observers treat this massive spending as routine. But this enormous outflow highlights the physical cost of acquiring advanced silicon chips and building infrastructure, like concrete data centers. Microsoft is shifting its financial profile from an asset-light software model into an asset-heavy reality, supported by $76.8 billion in cash reserves. Investors must carefully weigh whether this cash flow contraction is building a competitive moat or risking severe overcapacity. To understand the long-term impact of this spending, we must examine core unit economics. The gross margin compressed to 67.2%, down from a 68.6% gross margin in the previous year. Most analysts focus purely on top-line numbers and brush off a minor percentage point drop. However, this contraction is a critical signal that the underlying cost of delivering compute power is rising faster than the premium pricing of the software itself. Despite generating $40.6 billion in operating income, the business faces a reality where rising energy costs and hardware depreciation eat into core profitability. Once you grasp this dynamic, you will look at financial reports differently. If this trend persists, the firm will face structural changes to its historical profile, and these complexities extend down to final bottom-line reporting. Headline net income surged 31% to $35.8 billion, pushing diluted earnings per share to $4.81. Casual onlookers assume this reflects operational dominance. But when you strip away the immediate surface, you find these numbers were padded by $3.6 billion in one-time investment gains from strategic equity stakes. Without these non-operating benefits, the core operational beat is less dramatic than the earnings per share figures suggest. Management utilizes these strategic partnerships brilliantly, but headline earnings growth masks underlying unit economic pressures. This discrepancy warns us to look past the surface and focus strictly on the $55.4 billion in operating cash flow. This operational focus becomes critical when viewing business segments actively lagging behind the broader corporate growth rate. The more personal computing division experienced a 4% revenue contraction, dragged down heavily by a 10% decline in Xbox content and services revenue. Financial commentators often ignore this segment, mistakenly assuming enterprise cloud computing is the only thing that matters. But alongside reported severance charges, this reveals ongoing structural challenges in legacy consumer hardware, meaning devices like gaming consoles and laptops. Microsoft faces a strategic paradox where the enterprise cloud division must continually overperform to mask stagnation within this legacy portfolio. The firm will eventually be forced to reallocate capital away from consumer products and toward the $39.3 billion intelligent cloud division to maintain overall growth. But how exactly does the business maintain liquidity while funding this massive internal shift? The current ratio plummeted to 1.23, meaning liquid assets now barely cover immediate short-term obligations. With the annualized US Consumer Price Index inflation rate sitting at 3.5% and the federal funds rate target range set between 3.50% and 3.75%, the broader cost of capital remains highly relevant. Everyone wrongly assumes big tech is immune to macroeconomic headwinds. Yet, operating in an environment with annualized US gross domestic product growth of just 2.1% means corporate budgets are stretched thin. The company successfully forces clients to prioritize artificial intelligence software over other expenses, but relying on aggressive corporate spending while the broader economy experiences sluggish growth is inherently risky. This macroeconomic backdrop explains precisely why management is working to protect its shareholder base. The firm executed massive capital returns, deploying $4.6 billion in share repurchases and distributing $6.8 billion in cash dividends during the quarter. When you see this payout, the average investor simply assumes the business is rewarding loyalty. However, returning over $11.4 billion in total shareholder returns while doubling capital expenditures is a calculated display of financial dominance. The firm proves it can self-fund a global infrastructure revolution without taking on crippling debt, unlike smaller competitors struggling to keep pace. This leads us to one final financial strength metric that secures this entire expansion strategy against market volatility. The debt-to-equity ratio stands at an exceptionally low 0.09, meaning the business operates with virtually zero leverage risk. Wall Street continuously worries about the scale of these capital investments. But this specific debt-to-equity metric proves management is building its future empire using actual cash from operations rather than fueling growth with borrowed money. This simple rule is incredibly powerful when evaluating corporate balance sheets. This brings us right back to our opening question, asking if the market is mispricing this infrastructure spend. Aggressive capital deployment is a deliberate strategic choice, not a fundamental failure. Microsoft leverages $55.4 billion in operating cash flow to build a physical barrier to entry that competitors cannot match without destroying their balance sheets. The current valuation reflects a highly capable compounding machine successfully navigating a capital-intensive transition. While gross margins may remain pressured in the near term, the unprecedented $678 billion in remaining performance obligations guarantees tremendous revenue resilience. If the company maintains pricing power as new data centers come online, the firm will successfully transition from a software vendor into the foundational utility provider of the next digital era. I want to hear your take on whether these massive infrastructure investments are building an unbreakable monopoly, or if the market is underestimating the severe risk of overcapacity. Let me know in the comments. So hit subscribe so you won't miss what's next and jump straight to the next video, because that could be the very insight you need to get ahead.